Hello and welcome, and today we're going to be looking at Arista networks. During our stock analysis, we're going to explore the key pillars, examine the ownership, look back at past results, we'll find out what the analyst predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally we will summarise our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests that these are the key metrics when first evaluating a business. The first pillar we are going to explore is the earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. And this is a 54% increase since last year. Now let's look at the free cash flow, which is the money a business can generate from its operations. This is up an astonishing 343%. Then we come to the next pillar, which is revenue. And this tells us how good the company is at generating income before deducting expenses. And this is up by 33%. Book value is calculated by subtracting the total liabilities from the total assets, and this indicates the equity growth for the company. And over the last 12 months, book value is up by 47%. Now we want to turn our attention to the management of the business by looking at the return on invested capital and the return on equity. These two measures allow us to assess a company's efficiency at allocating capital under its control. Return on invested capital and return on equity are up by 29%. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. And Arista Networks has no debt. In this next section, we will now focus on other key metrics which will help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. And their gross margin is a healthy 62%. Next we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. And their operating profit margin is very good at 39%. Now we're going to look at the free cash flow yield, which is a financial ratio that compares the free cash flow per share of a company against its market value per share. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for a company that has a free cash flow yield of 5% or higher, and their free cash flow is 2.38%. After that, we come to the PE ratio, which Peter Lynch believes is a key indicator when evaluating if a company is under or overvalued. And lastly, we come to the enterprise value divided by earnings before interest and taxes. Like Peter Lynch, Joel Greenblatt uses this metric to identify if a company represents value for money. Their PE ratio is 40 and their enterprise value to EBIT is 33. We'll come back to Peter Lynch and Joel Greenblatt's valuations later on. This is Bitesize Investments, giving you a step-by-step approach to your investment journey. There are currently 4 super investors who own this company. If we look back at Paul Tudor Jones's previous sales and purchases, we can see he has both bought and sold shares in Arista Networks, but in the last quarter he has bought 16,000 shares. However, 7 other super investors have sold shares. Ray Dalio has constantly bought and sold Arista Network shares over the last few years, and in the last 2 quarters he has been selling at a nice profit. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. Since the company originally IPO'd, their share price was fairly flat, but since 2020, Arista Networks' average share price has rapidly increased. On average, the analysts believe that the price target should be about $275, but some believe it can go as high as $356. Analyst reports suggest that Arista Networks is currently at fair value, and the overall analyst consensus is that Arista is a buy at the moment. And collectively, the analysts believe that the company will continue to grow between 15 and 25% over the next 5 years. So I will use the current earnings per share of 6.59 as my starting point when creating a valuation. based on a combination of the past growth and future analyst predictions, I'm going to estimate the earnings per share will grow about 23%. I'm going to give Arista Networks a PE of 40. After that, I'm going to project these numbers forward by 10 years. This gives me an estimated future stock price of $2,090 per share for its future share price. Then we need to include our 15% return. Then we work out the current value that Phil Town calls the sticker price, which is $490. And then we apply a 50% margin of safety, which gives me a buy price of $240. But if we apply a 20% margin of safety, it gives us a buy price of $392. As we can't rely on just one valuation model, I'm going to dig a little deeper and gather some more information. In this next section, I'm going to get some help from some super investors. To start off with, I will use the Peter Lynch PE ratio model to help determine if the share price is overvalued, fairly valued, or undervalued. So we take the share price, add the dividend yield, and divide it by the current PE ratio. So using this valuation model, it suggests that Arista Networks is currently undervalued. Then we're going to move on to Warren Buffett's 10 cap model, where you divide the free cash flow with the market cap. The higher the percentage, the more the company is undervalued. So at 2%, this suggests it's a little overvalued at the moment. After that, we're going to move on to Joel Greenblatt's favourite tool for working out if a company is correctly valued, which is dividing the enterprise value by the earnings before interest and tax. At 31.39, this suggests it's a little overvalued at the moment. Finally, I've also included Phil Town's earnings per share growth model that I used earlier. With my 50% margin of safety being $240, it seems like a really good value, and I actually personally bought this at $245. If you're interested in reading any of the books by the super investors I've mentioned today, please look in the description to find out more information. In this next section, we're going to split the chart into different zones. Our first zone is a market bottom for Arista Networks, which is about $85. Then we come to zone 2, which is between $136 and $175. And then zone 3, which is between $175 and $238. And finally, we currently seem to be in zone 4, which I'm hoping will hit just over $300 and will represent a possible exit strategy. In this next section, we find out our potential return if we could buy at today's price and at our 50% margin of safety. The return we would receive if we bought at $265 and sold at $300 would be 13%. We would see a return of 25% if we bought at $240 and sold at $300. In this next graph, we're going to compare the operating profit margins of Arista Networks, Motorola, Garmin, Cisco and Ericsson. By comparing the operating profit margins, we can see the relative performance between Arista Networks and its similar competitors. The chart shows that Arista are better equipped and more efficient at generating profits from its core business activities than its competitors. Finally, let's summarise what we found out about the company. When reviewing the key pillars, Arista scored an excellent 9.5 out of 12. Under ownership, 4 super investors have bought in the last few quarters and 7 have sold shares. In the past 4 years, we can see the average share price has trended up. Analysts are indicating that Arista is a buy and they are predicting they will grow between 15 and 25% over the next 5 years. Using the different valuation models, my personal buy price was $245 per share and with about a 50% margin of safety. My final overall rating is 4 stars out of 5 and I have given this a category A rating within my own stock watch list. I have personally bought into this company, but this is not a recommendation for you to do this as well. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comments section to help me develop the content I'm creating. And lastly, if you've enjoyed the video, it would be greatly appreciated if you could like and subscribe to help the channel grow.